Today, we're going to talk about the 4 ways to analyze a rental property to see if it would be a good investment. The first one is cash flow. Cash flow is the money that is left over after all expenses are paid. So essentially, let's say you're making $1,500 a month in rent. If your expenses are $1,200, including the mortgage, taxes, insurance, miscellaneous repairs, we account for vacancy, and we like to account for some unexpected repairs. If an HVAC goes out or if we need to call a plumber, we want to account for those things. Income is 1,500, expenses are 1,200. Our cash flow for that property is going to be $300 a month. Method number 2 is cash on cash return. This builds off of cash flow because you need to know your cash flow to calculate the cash on cash return. So take your monthly cash flow, using the previous example, let's say $300 a month, multiply it by 12, and that's your annual cash flow. So for that property, you would expect $3,600 in annual cash flow. To calculate the cash on cash return, you're basically taking the cash flow that you're receiving and putting it against how much money do you have invested in this property. Between the down payment and the repairs and maintenance and everything that you did to get it ready to rent, you spent $50,000. So if you're making $3,600 per year and you have $50,000 tied up in the property, you take 3,600 divided by 50,000 and your cash on cash return is 7.2%, which you can compare that to stocks. And, that's pretty comparable as terms of return on investment. Keep in mind, when you're calculating cash on cash return, that's only taking into consideration the cash flow. In future videos, we're going to go over the other ways that real estate can make you money other than just cash flow. There's appreciation, there's loan pay down, there's 3 or 4 different ways that real estate adds value over what a traditional investment vehicle would provide. The third metric to analyze a rental property is by looking at its capitalization rate, also called cap rate for short. Cap rate is your rate of return without taking debt service, which is your mortgage payment, into consideration. So essentially, if you bought a property for cash, this would be your rate of return on that. So let's use an example of a $1 million property. You purchase for $1 million. It grosses $100,000 a year in income. To calculate cap rate, you don't use the gross income, you use the net operating income, or NOI for short. To calculate the NOI, you take the gross income and subtract all the expenses, repairs, maintenance, utilities, property management fees, vacancy rates, subtract all of that out, excluding the debt service. You don't subtract any mortgage payments, and then you get your net operating income. So let's say if your gross income is 100,000, all your expenses are 50,000 for the year, then your net operating income is $50,000. You take that $50,000 divided by the $1 million purchase price, and you get 5%. So you have a 5% cap rate for that property. Now you may ask, is 5% good? It really depends on what your investment goals are, where you're located, and how the market is doing. If you're in California and you're buying a large apartment building, the cap rate's probably going to be 4 to 5%, maybe lower. It really just depends. If you're in the Midwest, cap rates may be a little higher. If you're purchasing a single family home, it may be 7 to 10%. A higher cap rate typically indicates a higher return, but there's also a higher implied risk. A lower cap rate, which you may see in more commercial deals, will indicate a lower return, but it also means there's a lower implied risk with that investment. So definitely take a look at cap rate, but if you're purchasing a rental property with financing, I would look more at the monthly and yearly cash flow and your overall cash on cash return, because that's really going to be what you're netting at the end of the day. The fourth method of analyzing a rental property is by looking at whether it meets what is called the 1% rule. The 1% rule suggests that the monthly rent should be at least 1% of the purchase price of the property. So for example, if you have a property that generates $1,000 a month of gross income, you divide that by the purchase price of the property. So if the purchase price is $100,000, then that meets the 1% rule. If you're making $1,000 a month in gross income and the property cost $200,000, you're only making 0.5%. The 1% rule is not a hard and fast rule. Honestly, in the past, maybe 5, 10 years ago, you could find a lot of properties that would meet that 1% rule. Ever since COVID, when prices exploded, it's really hard to find a property that meets the 1% rule. Sometimes it'll be 0.8% or 0.9%. It's really close. And you really just have to look at whether the property's cash flowing, look at the cash on cash return. That's honestly more important. But the 1% rule was a quick way to rule out properties that would be a really bad investment. So if you're looking at a $300,000 house and it's only making $1,200 a month of rental income, obviously it's a bad investment choice in terms of cash flow is concerned. So it's really just a tool that you can use to quickly eliminate bad investments, but to really sit down and analyze whether this would be a good investment, you should probably focus on looking at the cash flow, cash on cash return, or cap rate. Do you want to learn how to build wealth through real estate? Then share and follow for more content like this. Thanks for watching.